Hello, and welcome to the latest instalment of Market Financial Solutions Conversations with Connor. Before we dive into today's episode, I want to take a moment to share a quick disclaimer. Market Financial Solutions are a bridging loan and buy-to-let mortgage provider and are not legal, financial, investment, or tax advisors. This document is for informational purposes only and does not and should not be considered to constitute legal, financial, investment, or tax advice, or be relied upon by any person to make a legal, financial, investment, or tax decision. Therefore, investors are encouraged to seek appropriate professional advice. The opinions and views expressed in this episode are personal to the host and may not reflect the views of Market Financial Solutions. Now let's get started. Straight into it today. We're seeing new and refreshed markets and buyers emerge in the property scene, and many may prove surprising. Hampton's data shows that foreign nationals are buying UK buy-to-let properties in greater numbers. Specifically, Indian nationals are leading the charge here, followed by Nigerian investors. In terms of property types, commercial assets are rebounding. Allsop, the UK's largest property auction house, raised 64 million at its September commercial auction, a new record for live-streamed commercial auctions in the UK. Also, it achieved a success rate of 74%. Meanwhile, Rightmove found that commercial property demand jumped in Q3, driven primarily by retail, office, and industrial assets. But I think what proved to be the biggest property news trend to emerge in October was a revelation that the market is being swayed by millennials. As a generation, we've been told they simply do not have enough economic weight behind them to have much of an impact. But it looks like that's just not the case anymore. Millennials are projected to establish just over 33,000 buy-to-let companies in 2025, a 142% increase since 2020. For the first time, they make up half of all new shareholders in buy-to-let companies across England and Wales, marking a generational change in property investment at large. Buyers at large could also be getting younger. First-time mortgage applications have risen by 11% since the start of the year, and these new buyers are attracted to new builds specifically, according to a recent survey. There's a lot of newness here. We could see more of this down the line too, as the government launched a major home buying reform proposal in October. While the proposal is wide-ranging, it intends to lower costs, speed up transactions, strengthen consumer protection, and reduce failed sales. The state claims this is the biggest shake-up to the home buying system in history. Well, we'll have to wait and see. Looking at the rental market, we had some heartwarming bits of news emerge over the past month. Landlords are often portrayed, as I'm sure you're aware, as the bad guys. They prey on defenseless tenants, etc., etc. But as should be obvious, that simply isn't true. And the data keeps on proving that. Poll from Pegasus Insights found that service satisfaction is 81% among tenants renting from individual landlords, and 70% of these tenants described their most recent rental experience as positive. And thankfully, there are signs that all the negativity out there won't completely derail investment plans as we head into 2026. The latest lettings report from Leaders Romans Group found that 60% of landlords intend to maintain their portfolio despite all the pressures out there. In fact, it seems that many landlords are actually expanding or entering the market for the first time. UK finance data released a few days ago shows buy-to-let lending remains largely unchanged in Q2, with nearly 50,000 new loans advanced with a total value of about 8.8 billion. Also, its data showed that gross rental yields increased to 7.26%, up from 6.9% a year earlier. Even in London, where costs and pressures are at their highest, rental values have been strengthening in the prime areas. Knight Frank found that the annual increase in prime central London was 1.8% in September, rising from 0.6% in January at the beginning of the year. Focusing on the news stories which could directly affect the bridging scene, two specifically caught my eye in recent weeks. First off, research from Nationwide found that home improvements can add up to 24% to property values. Specifically, adding a bedroom through an extension or loft conversion can be particularly lucrative. As a reminder, we offer tailored loans for these kinds of improvements and upgrades. Also, it's been reported that in the southeast, brokers are struggling with stalled transactions as issues emerge in the buying process. Chains are under pressure, and bridging finance, as we all know, is there for when they break entirely. Of course, this is the last update from me before the autumn budget, and the wider economic picture leading up to it is a bit mixed. There's no telling how much wiggle room the Chancellor actually has. There's been so much speculation on what she'll announce that I'd rather not cover it here. I think it's better if we wait to know for sure what's on the way before we dive into what it all means. What we do know is that inflation held steady at 3.8% in September, a much needed result. What's more, our economy grew slightly in August. Growth of 0.1% is still better than a decline. House prices are also holding steady. Nationwide, Rightmove, and the ONS all recorded growth, although Halifax showed a slight dip. More specifically, Zoopla found that first-time buyer home prices are outpacing the rest of the market, and that capital gains enjoyed by house sellers are more than double those of flat sellers. And finally, there's the elephant in the room. As I was preparing this update, the Renters' Rights Bill received royal assent and became law on the 27th of October. It's arrived, and you need to ready yourself. I've covered the bill and its ramifications in so many bits of content that I've lost count. I'm not going to go over it again here. I'll wait until the dust settles to see how the market reacts in the immediate aftermath. But if you want to get to grips with the essentials, please head to our website where we've covered the bill in blogs, reports, and more. This should all give you and your clients plenty to think about. Over the coming weeks, we'll all need to assess what we could be targeting, how the market will shift, and what the reactions will be to the budget. I'll see you next month when we all have a bit more clarity on where we stand. Thank you. If you enjoyed this episode, don't forget to subscribe, like, and share. You can access our previous episodes in all the usual places, as well as on our website at www.mfsuk.com/podcast. See you next time.